Ladies and gentlemen, I guess it's time to get started here, and I would like to welcome all of you, our panelists, moderator, and of course our audience to this event on sustainable agriculture in Africa, the first of a series organized and here and hosted by the Global Policy Institute and Bay Atlantic University in Washington, D.C. I am Paolo von Schirach. I have the privilege of serving as a president of the Global Policy Institute and chair of political science and international relations at Bay Atlantic University. This series of events, which broadly are about sustainable development in a broader sense, not just about Africa that we are going to talk about today and in other events as well, also put together in partnership with our friends and colleagues from Istanbul at Bahcesehir University, where there is a unit of UNITAR, the UN Institute for Training, Research and Research. And so we are going to have students attending from Istanbul who are focusing on sustainability issues. So without further ado, I would like to get this meeting going, and I would like to introduce our moderator, friend and colleague of many years, Adam Saffer, who is not only a practitioner, I guess that's kind of an understatement, in the whole business of economic development and beyond, and you know, organizations and you know, capacity building and training, all kinds of things. There are too many to list all of them, and who spent recently quality time working exactly on these issues, running a big project in Nigeria on agricultural matters. And last but not least, he's kind enough to serve on the board of the Global Policy Institute. And Adam on sustainable agriculture in Africa, and then others on related themes. So without further ado, let me turn it to my good friend Adam, who will be moderating this event. Thank you, Adam.
Thank you. Thank you, Paolo, and welcome all to, as Paolo said, the first of a series of webinars on sustainable agriculture in Africa. Today's one-hour program comprises presentations from 3 highly qualified and successful entrepreneurs who focus on realizing the vast socioeconomic potential agriculture has in Africa. The format today will be for each speaker to make a brief presentation. This will be followed by questions and answers. There'll be a period for you to write in. Preferably, type your questions in at any time using the Q&A box at the bottom of your screen. And I'll be monitoring those, and then we'll be grabbing those questions. Please include your name, institution, and keep your questions as straightforward and brief as possible. So today's topic, development finance, is an increasingly broad landscape with a myriad of players, including equity investors, grant makers, commercial banks, government banks, microfinance institutions, NGOs, bilateral donors, and multilateral development banks, to mention a few. And its goals are equally diverse, including job creation, poverty relief, gender equity, technology transfer, digitization, and climate change. So while access to finance investment is not a panacea, it is demonstrably one of the key constraints to starting and scaling any business, especially agribusiness. So rather than spend time with formal introductions of the speakers, I suggest you review the profiles of each speaker, which was sent in the invitation. And so let's jump right in and start with Mizu Nwele, the managing partner of Sahel Agribusiness Capital, which is a food and agriculture private equity firm which invests in mid-size agribusinesses. Welcome, Mizu. Thank you, Adam. Great to be here. Thanks, thanks. You know, Sahel Capital has been active in the food industry, in the food and agricultural sector in West Africa for about a decade now, if I remember correctly. Can you provide us with an overview of your investment approach and some of the investments you have done in the region, and whether or not you focus on primary agriculture or post-harvest processing, packaging and sales and storage, or both?
Sure, thank you. And as context, being active, as you mentioned, the past 10 years, we have a 66 odd million dollar fund. We invest across the value chain, everything from integrated processing to packaged food and snacks to logistics to ag tech, so really broad spectrum. We can do minority investments, we can do majority investments. We have done both. We invest up to $8 million ticket size in companies. In our portfolio, we have 7 companies today: dairy, rice, cassava, shea, poultry, a real broad spectrum. I think in terms of approach, there are a number of different things we look at. So, one is, are our investments addressing, hard problems? For example, food scarcity. Africa's population is going to grow dramatically over the next decade. How are we investing in companies that can provide, staple foods to feed, these masses of people? From import substitution, how are we investing in companies that can produce products that meet domestic needs with domestic supply chains and do so in a way that is competitive regardless of government policy? We look at how to fix broken value chains, so a real broad spectrum. We shy away from production only because commercial farming is hard to do and it's hard to get the returns you need there. But where we do that, it's part of an integrated platform. And we're also very attentive to portfolio construction in terms of making sure from a portfolio construction perspective that we have enough diversity. So the last comment on this in terms of approach is, it's not just providing capital to companies that need it. It's also making sure that you wrap around the right technical support and expertise around that capital as you invest. So on our team, we have very experienced operations people who have built and run companies before, so that in addition to bringing that capital, we can bring expertise to help the entrepreneurs with value creation plans.
Well, thank you. I've been in the field for a while as well, and I just have to ask this question. I don't mean to put you on the spot, but why do you believe there is an investment opportunity within food and agriculture in Africa with so many variables, so many risks, the risks of SMEs and smallholder businesses, the climate, the government, the market? Tell me what drives you and where you really find the opportunities.
Sure, I'll speak at it from 2 angles. The first, commercial, financial, and then the other impact. So from a financial opportunity perspective, if you look at the food and agriculture ecosystem and you project out, 20, 30 years, global population growth is going to be driven by population growth on the continent. So effectively, more people requiring more food to eat. And the question really is not whether this food will be provided, but will the food be provided by domestic entrepreneurs or will be provided by imports? And we're a big believer in the importance and need to back domestic entrepreneurs to meet this demand. And especially if you look at, what we all saw with COVID over the past year, shorter, more local supply chains, food routes to end consumer is critical. It's not enough just to have food available, but that food needs to actually get to that end consumer. And so if you take that into account, that you have more people driving, more demand for food and you need shorter supply chains, it means there's an opportunity to back and support domestic entrepreneurs by meeting that requirement. The other is that the demographics are also changing, quite rapidly on the continent. You have, urbanization in East Africa and West Africa. The urbanization rates are much higher than you see in Asia. So effectively, more people moving faster from rural communities to urban communities. And this is changing consumption patterns. So people looking for more packaged food, more convenience. Right. And ultimately, this would drive new types of products that, potentially if you're an entrepreneur providing this product or service, there's an opportunity demand there. And then, of course, if we take into account technology, solving hard problems, I think there are a range of opportunities you can look at. Now, from an impact perspective, there is, no other region where, through allocation of capital, you can have system-wide impact in the lives of people. And I think ultimately, if you think about the average individual in many African cities, and I'll just use Nigeria as context, roughly 60% of income is allocated to food purchases. And so food is expensive relative to income. So the question as well is, over time, how are you investing, solving problems, reducing the cost of food, and so not just for the consumer, reduce the cost of food, but how you also increasing income for domestic farmers. So the commercial opportunity is very exciting for us, but at the same time, to impact a broad spectrum of lives is really I think that really drives us alongside that commercial opportunity.
Right, and as you mentioned, there's the food security of the country, and then there's the food security of the continent, food security, nutritional security of the world. And I think the inter-Africa trade has got to be a big piece of the puzzle for many investments. I don't want to make this webinar just a gripe session of all the challenges that agricultural businesses face, but there are many people on the call who have not lived that experience, have not seen the struggles with getting not only the appropriate inputs, but knowing how to apply the right amount of inputs, or issues with respect to rain-fed seasons and rainy season and dry season, relying on irrigation, which relies on pumps, which relies on fuel, et cetera, et cetera. So from your perspective, and you're looking at these different opportunities across the region, what are some of the key challenges that are specific to this sector that you would need to work on?
So there are a broad range of challenges, and the challenges, the flip side of the coin is the opportunity. So yields are very low for a number of different reasons. A lot of farmers are not using improved seeds or the right crop inputs. So that impacts yields, impacts potential competitiveness of the end product. But at the same time, it creates opportunities for those that are able to make investments into either commercial farms or farms backed by outgrowers you're providing the requisite support to. And if you're able to do that, you can then boost yields to more competitive levels. You mentioned irrigation. Irrigation is important because quite a bit of agriculture on the continent is rain-fed. And so as you're thinking of improving efficiencies, how do you enable year-round farming? So for example, one of our companies, we have a very large commercial farm, cropping rice, and we have irrigation there to allow us to farm through the year. And that's huge for us, enables us to boost our returns, but irrigation is not commonplace throughout the continent. So putting that in place is important. And of course, transportation costs are high because infrastructure road network is not great. And then, data, not a lot of data. So you have to really build your own, data through primary gathering to, be able to make better decisions. And, people talent is also important because, a lot of the talent wants to be in the big cities. And it's harder to get talent to go to smaller towns and rural areas to work. And if you're an entrepreneur building your business in small town, name your country, then, that's great. But as you build your business, you need to build a strong middle management team layer. And that means, attracting that talent. So figuring out solutions that enables good quality talent to join businesses doing very interesting things to enable them grow. I think, it's a challenge, but I think there's solutions as well to solve that.
Right. When I was in the last couple of years being in Nigeria, one of the things I kept finding was, when I asked some of these smaller size, the smallholder farmers and small SMEs servicing the business, what would it take for you to be 10x, 10 times the size? They just stared at me blindly as if I was asking an insane question. And so I would assume when you're looking at possible investments, that not only does the team have to be there, but the strategy to grow and expand, be it product wise or geographically wise, and get more efficient, in terms of costs, in terms of waste, in terms of being able to react to market changes. It's challenging, but equally rewarding because the potential is there. Certainly in your part of the world. Other than the sort of production-related, infrastructure-related constraints, government has a lot to do with it, government policy. And I would like to, from your perspective, you know, be it a general business law or a regulation or agriculture specific, what would you recommend if you were king to focus on in terms of the impact to change the dynamics within the sector from a policy reform perspective? What comes to mind?
Sure. And this is a very tough question, and a lot of debates around this, both in government and outside, you know, because, you know, if it was straightforward to implement, it would have been done already. Now, you know, in my view, there are probably two areas where they could be, you know, exponential impact. And, you know, it's, yes, stuff can be done around, you know, tariffs to support local industry. Yes, stuff can be done to provide improved inputs. But I think for me, the two areas where there could be more work done, I touched on one earlier, which is around infrastructure investments around irrigation. Because where you have irrigation can't be done by small farmers. It's very expensive to do for commercial players. And this is really where if various governments, you know, did work around irrigation support, even farming communities, you effectively enable farmers to farm throughout the year and not to be dependent on rain-fed farming. And that has huge implications, helps them farm, boost yields. And if I use Nigeria in particular, a lot of the irrigation infrastructure that is around the country was built in the late 70s and early 80s by certain state governments. And farmers today are benefiting from that. So that one is huge. The other one is a softer, harder issue, which is there's quite a bit of dislocation happening in many regional countries because of security-related issues. And, you know, this is northern Nigeria, this is Mali, Niger, you know, even some parts of Kenya. You can look across the continent. And where you have security-related issues, it makes it more difficult for farmers to farm, or where they do farm, they potentially their harvest could be impacted. And this ultimately feeds all the way down the chain to, you know, food volumes produced, pricing, etc. And it's a hard issue that many people are trying within the Sahelian region to address, but really needs to be, you know, lots of work, and it really needs to be paid attention to this because it would have dramatic implications on the ability of the farmer to farm and investment capital to the region, and ultimately, you know, food prices, you know, both in rural and urban centers.
Mm-hmm. Well, as a lead-in perhaps to the next speaker, I wanted to ask you about your perspective on the, you know, the human capital aspects and how these farmers, if it's through you or somehow in a blended portfolio, get access to extension, get access to technical assistance and training. And from a contract law perspective, the relationship between the off-taker and the outsourced farmer. I mean, some of these small farmers, right, are in co-ops and groups, and some are hired as under contract farming. Now, contract farming has not done really well in some parts of Africa. And I'm just curious, from your mind, when looking at a company, what's the best method you've seen to build that capacity, that human capital, and create the value in those companies that you need before you exit?
Sure. And there's no one right way. There are many different avenues, and I know both Ayo and Jerry, who speak later, you know, do quite a bit of that as well. Mm-hmm. And you know, a few things we've done. So the first is on our team we have a pretty deep bench of people that have agronomy experience, have built factories in their previous careers. So when we provide capital, we also effectively provide this talent availability to theontrepreneurs. So they provide advice, everything from supply chain to farmer, all the way en route to market, picking equipment, you know, so there's quite a bit of engagement we spend to ensure that the entrepreneurs themselves, you know, have access to, you know, talent, knowledge to provide the support they need. We also spend quite a bit of time also recruiting into companies. So working with those entrepreneurs to find people that we can recruit to join teams. You know, where that talent may be expensive, we have a small pot of grant money we can use to cover some costs for a very short period of time until they get embedded. We also do, you know, cross-portfolio training on different, either, you know, finance related or supply chain. We do so the broad range that we do with different service providers. On the farmer level, we have individuals on our team that do, training with the farmers and farming practice. We help them get inputs they need.
Right.
So from the farmer level to the entrepreneur, I think we are engaged quite a bit. I think the hard question is really the cost of that support, and what does it mean vis-a-vis the amount of money you are investing? Because the larger the amount of money you're invested, the easier it is to justify that,
Right.
support. The smaller the ticket size, the harder. But I think there's a broad range of support that can be provided and is tailored to the company's requirement or their supply chain's requirement as needed.
Well, thank you. I could listen to you, all day, Mizzou, and I look forward to staying close to Sahel Capital. Thank you for that.
Thank you.
Sahel Capital also manages the Fund for Agricultural Finance in Nigeria, FAFIN, which I believe is a $66 million fund. And good luck and thank you again.
Thank you.
Questions, please direct them to the Q&A box. I'm now going to move to our next speaker, Ayodeji Balogun, and he is the CEO of Afex Nigeria, a company that utilizes technology to connect agri-SMEs and smallholder farmers to community and financial markets. Welcome, Ayodeji. It's nice to see you again, and appreciate you being here.
Always a pleasure, Adam. Nice here.
Thanks. Carrying on from that last question with Mizzou about connecting to the market and the need for the relationship between producers and off-takers, I would like to ask you a little bit about that. I mean, agricultural finance has such potential to help provide the food that's required, and really, given that it's about 25% of typical GDP and employs maybe in some way, shape, or form half the population. I'd like to start with asking you about access to finance and what are some of the key challenges in unlocking credit. Now, this is not exactly an investment play. I wanted to look at the other side of a debt play, and some of the key challenges in your mind of unlocking the credit for these groups of farmers, which typically, don't have a 3-year balance sheets and a lot of collateral and a lot of history with these banks.
Thank you very much. And so the first thing where it starts from is data. Data isn't something that is very accessible and easy to find and easy to interpret and do comparable. So if you were in a developed world and you wanted to finance a company, you could look at them on Bloomberg or any other to get their financials. So credit data, loan performance repayment history, even like financial data. A lot of agri-SMEs do not even have the cash flow to be able to get a good consulting firm to help them prepare their financial statements in a way that a traditional financial institution could be. So the first gap is data and being able to present the information and the credit history and profile of these agri-SMEs in a way that the financial system understands. The second part is also around how traditional lenders lend. Bankers simply look at the cash flow, they look at the collateral, and then they look at the credibility of who is lending. If you take an average agri-SME or a smallholder farmer who has an annual income of about $1,200 per, which is very low, but that's sort of like the average.
Mm-hmm.
And then you say first is on the cash flow. It ends once in a year because it's rain-fed agriculture. It plants, during the beginning of the rain, harvest 4, 5, 6 months later, and sell it, and that's 80% of his annual income. So he doesn't have the predictability or a monthly cash flow that a traditional bank wants to see. The second is from a collateral standpoint, his land is far away in the farm, in the rural area. It has no asset value. There are no titles available for him, and so it doesn't qualify to be used as a collateral in a traditional banking structure. The third is the character, and then you look at him, if there was data, if you could profile him or his business, if business registrations were a lot easier for smaller enterprises, then you will be able to then have something to hold back on. So when these three things don't tick off, traditionally you just push out traditional lenders to agri-SMEs and producers in the developed market. So these are some of the constraints, and for us to start to fix it and to put in terms of the importance or the scale of the challenge. So the size of lending and you compare it with the size of the sector, lending to agriculture from the formal system is only 2% of the size of the sector. It's definitely not enough to drive the kind of growth that could lead to increased productivity, growth, finance, innovation, and other opportunities, especially for a sector that contributes 26% of Nigeria's economy, close to 30% of sub-Saharan Africa's economy, and employs over 75% of the labor.
Thank you. Thank you. You know, there are several schemes that various companies have put together to try to address those issues. You know, there's possible tripartite relations where the bank, the lender, the producer, and someone, let's say like yourself, will do a tripartite relationship, get the money for the inputs before the season, and then pay that money back to the bank upon harvest. And there's lots of ways to do that. What are some of the best examples that you've seen around Africa in getting the SMEs, the finance they need predominantly for inputs?
I'll say our example is the best just because I'm biased.
I knew you were going to say that, you know.
No, but if you look at one of the things that we've imagined, it's evolved in the last decade. I would say Kenya has taken the lead in sort of like value chain financing, but there's been outstanding innovations in Nigeria as well. And then a few other countries that we start to see. What you then see is when you have people, because the part of the challenge is the transaction cost for traditional financial institutions to aggregate farmers, the cost of origination, processing, transaction documentation, disbursement, all those things build up the cost for a loan that is about $300 over 6 months. So it just doesn't make sense. So what you've seen evolve is sort of what we call aggregators. And these are players that come in, provide services primarily to smallholder farmers, group them, bring them into cooperatives, and then use a blend of different mechanisms to securitize the transaction. So in our case, we use the group trust dynamics between the farmers. We use a blend of understanding their history and being able to mine a lot of data points to then say, you know, how many meetings are they holding? What is the interaction? What is the age of the leaders? What are the number of feedback? What are the number of transaction types they use with us? And we use that to build a credit rating from the farmer. And that influences how we then serve them better. Now, this kind of entities then find different ways to blend different tiers of capital, pull it together, and then give it on to the farmer. But not just as a loan. So, right, when we take a farmer and we are financing him, we're giving him the right inputs, which is the fertilizer, the seeds, the CPPs. He gets the right training. He's connected to a warehouse where he then accesses the services, but also can store his grain. So we provide storage as a service to them. And when it's time to sell, they could also bring the grains and then they could sell it. And they could sell either spot, meaning they sell immediately for cash, or they could sell it 3 months down the line and earn a premium above prevailing market prices. So these service providers unbundle financing as part of the whole package that goes to the farmer. And we've seen tremendous productivity. Savings and incomes have risen by about 200 and 300% over 3 to 4 years in our experience doing this. And today we serve over 200,000 smallholder farmers across the country. Now, another example of some of the things that we've seen if you move up the chain into agri-SMEs, producers primarily, was because agriculture is rain-fed primarily, meaning that everybody harvests around the same time and prices, demand and supply, prices are lower right around harvest. So as a processor, what you want to do is to go into the market and then buy for as many months as you can, because then you have predictable availability of products. but also you're also able to then control your price and ensure your raw material cost is in control. Now, the challenge is that a lot of the agri-SMEs only have working capital to finance 2 months of inventory, maybe 3 months. Then they end up just buying in and coming back into the market when prices are higher, and then ended up paying 30 to 40% higher on prices of this commodity 6 months down the line. Now, what we did last year was to issue what is we call the first warehouse receipt-backed commercial paper. So it's almost like the way you have mortgage-backed securities, in the financial markets. We then take these commodities in a warehouse, securitized by the warehouse receipt, which is like your share certificate for stock. And that then becomes the collateral. And then we layer that on top of the commercial paper, and the corporate or an agri-SME who typically would not have met investment grade now falls within the investment grade rating, and we're able to then raise capital. Last year, we raised $50 million for about 5 or 6 of these agri-SMEs. And these are some of the innovations that we keep pushing out to increase the level of flow of capital to the food systems.
Did you tell me, let's talk about the exchange itself, the commodity exchange, your involvement in getting commercial ag-backed paper into the capital markets. I mean, this is quite an innovative road, and I don't know exactly where you are with it right now, but it sounds like it's taken off, and it'd be interesting for the audience to see how you de-risk the agricultural space a bit to try to sustain the inflow through these exchanges.
Yeah, thank you, Adam. So if you wanted to, if you're a processor in US or you're a large farm, immediately you start to go to farm. Probably you're growing wheat or you're growing corn. You sell your harvest, which is 6 months down the line from the point when you start to farm. So you lock up your price, you lock up your contract to sell, and you're not exposed to both market risk and price risks. Now, besides climate risks, which you could manage with, droughts, with improved seeds or insurance, those are your 2 biggest risks as a farmer. Now, imagine a farmer in sub-Saharan Africa has no way today to lock up their price risk, neither do they are able to lock up their market risk, meaning that they start harvesting, they plant, they put all their investments into the farm, and then they wait 6 months upon harvest. When they harvest, only to find and be left at the mercy of whatever the buyers are willing and ready to pay. Or, look at last year with the wake of COVID. You go to farm, you expect for the best, and then something as dramatic as that happened, and you're left to the whims without any risk coping mechanism. Now, fundamentally, that's what the exchange is supposed to provide. It's supposed to provide risk hedging mechanisms for smallholder farmers, but also agri-processors in the markets, where they can manage their price risk, but also be assured that there is a market for the commodities they are producing. Now, part of that process is ensuring that when that product then gets into a warehouse, you can preserve the value and the integrity of it. Then the products can then be sold, and buyers and sellers, multiple buyers and sellers, can buy that commodity and sell it. And eventually it could be the 4th or the 5th buyer that then comes back to say, I want to load my products, and then it's there, graded, standardized. Now, when we started this business in 2012, our first investment was in Rwanda. And one of the first things we found out was that the grading mechanism to standardize corn, to make sure that corn, in Nigeria could be the same corn in Ghana, in Kenya, in Rwanda. Even within the country, that standard just didn't exist. Practices to store grains and keep it just wasn't there. So we've had to really build this ecosystem and ensure that we could provide the trade infrastructure that could support the growth of the exchange. And then on top of that, now build the layer of technology that we know is adaptable to the continent, is mobile friendly, and is within reach to the smallholder farmer and the processors. So it's been a journey. I remember both Jerry and Mezur, when I started in agriculture a decade ago, It was interesting. They had the same kind of few gray hairs I had then. Now I look at them and it's like, what is going to look like? Agriculture in sub-Saharan Africa is a lot of work to get done. And while we could digitize a lot of this process, there's still a lot of heavy hands-on work that needs to get done to make it work.
Deji, I used to have some gray hairs too, and I'm pleased to see that all four of us go to the same salon. And if anyone needs recommendations on that, we can provide. You can just contact us, and investment, of course. But thank you. Thank you. I think we're running a bit late, Deji. You are indeed breaking new ground in Nigeria. You're setting a precedent, I think, for the commodity markets, the capital markets across the continent. And having worked with your team before, you know, I'm very confident you're going to achieve, if not exceed, all your goals and objectives. We'll come back to you in questions and answers. I wanted to mention to Mizzou as well as you, Deji, about the issues of security and the logistics of getting product to the silos or to the warehouses or to the market, because that is a growing concern in many countries in Africa. But let us now go to last but not least, excuse me, our final speaker is Jerry Parks. Jerry is the CEO and co-founder of Njaro Capital Investments, based in Accra, Ghana. Njaro is featured as a top impact investment fund manager globally in 2015, and in 2018 received the Portfolio Company of the Year award at the Private Equity Awards in London. You're on a roll. I'm wondering, Jerry, given your background, what you're doing in agriculture in the first place, but I welcome you and look forward to hearing the bit of the Njaro story. But let's just take a moment, because we had a chance to speak earlier, and I know your background, but I think for the benefit of the audience, it might be interesting to hear how you went from being a sort of an embedded software systems engineer to an investor, and then to boot, an investor in agriculture. Jerry?
Thank you very much, Adam, and thanks for offering me a platform alongside these great colleagues in the sector. I suspect that my story in many ways is going to be very similar to that of Mezuo and Ayo, because I can imagine that when we were growing up, not many of us actually got trained in the field of agriculture. For me personally, the big driver was I was sitting at a desk writing some complex code, and suddenly I asked myself, if I continue doing this for the next 10, 15 years, I'm going to end up spending the rest of my life living in the West, and then I'll never get a chance to actually do something that matters to my African brothers and sisters. So I then figured out that I needed to change directions and figure out a way to become more relevant to solving the problems that existed in Africa. So to cut a long story short, that led me to move away from being an engineer, retrain, move into the world of finance. And then the actual entree into agriculture was partly accidental. The objective was to start an SME fund that would help small businesses in West Africa, Anglophone and Francophone, raise capital so they could grow and in so doing contribute to Africa's economic development. We arbitrarily decided to include agriculture as a potential sector because we felt like that sector would enable us to impact a lot of people due to the sheer number of people involved in agriculture. And that ended up becoming the core strategy because investors at the time we were fundraising saw agriculture as the ultimate impact investment in terms of the number of people it could impact, the fact that it could help raise people out of poverty, etc. So that's in a nutshell is how we ended up being in agriculture. We literally had one investor saying to us, you want to do agriculture as one of your sectors? However, if you were doing only agriculture, we'd invest in you tomorrow. So we did the pragmatic thing as founders and said yes, and here we are today. Oh, you might be on mute.
Thanks. Yeah, my family prefers me on mute, but I will open it up. You know, access to capital, access to commercial investment in Africa is, you know, is struggling. And not just the last year of COVID, but it's hard to attract commercial capital to Africa. You've got a lot of donors, a lot of concessionary funds. And to boot, agriculture is even perceived, and indeed is even more risky in some respects. So I'm wondering how hard it was for you to raise money to start Njaro and in the agricultural space, because there hopefully will be more and more people looking at the sector and coming to Africa to help out.
When Mesro spoke earlier, he mentioned the term hard problems, you know, and investing in agricultural SMEs, I would say, especially in West Africa, is one of those hard problems. And I think this is something that the market has begun to recognize, that while impact investments can be made with financial return, not all types of impact problems have the same level of difficulty. Fortunately for us, we came across several investors who recognized this difficulty, and especially given the fact that we were also targeting countries like Mali, Niger, and Burkina Faso, there's a lot more sympathy around offering concessional terms, or even giving a relatively new team in the market the opportunity to tackle some of these hard problems. So that helped us attract investors like AGRA, the Soros Economic Development Fund, the Lundin Foundation out of Canada, all organizations that were willing to take the startup risk or the early stage risk in West Africa, in the agriculture sector, all for the sake of trying to make the impact in the lives of smallholder farmers and people in rural communities. So that made it possible. And fast forward roughly a decade, we're very happy to say that there are about 3.7 million people living in West Africa who've benefited from the capital that we deployed across these countries. And by focusing, having that laser eye focus on what we call our target impact classes, we've been able to stay true to the game and outperform the targets that we were giving. We were hoping for about 1.125 million people impacted. We've been able to impact about 3.7 million. It's not been easy, and I still feel like we could have done a lot more, but all we can do is keep on pushing. And in terms of things that can actually make it easier to raise capital in the future, you've probably all heard about the concept of blended finance, i.e. bringing together the NGO money with the commercial money and structuring it in a smart way to make it financially viable to actually deploy capital. I think this is one of the things that gives us quite a bit of hope. So for anyone out there who's thinking about doing it, think along the lines of blended finance.
Absolutely, absolutely. I want to pursue that just for a second, Jerry, if I may. Yeah. You know, you talk about impact investors previously, that type of asset class, which I'm interested in. Will that be enough? Will that last? You know, combining that with donor and development bank DFI money, combining that with commercial finance. How do you see the future in the next few years, not restricting it to the COVID situation, the balance? It will be blended for sure, but in terms of percentages, are you seeing real potential for corporate commercial finance to come in here? Do we really need the donors? Do they play a big role with some of the grant funds or concessionary funds? And you've got a very interesting asset class of impact investors, but that term has been muddled and used so often from the likes of Fortune 100 companies to startups to NGOs. It's sort of like corporate social responsibility. What does it really mean? So what's your view on the major asset classes and investors that will come and be committed to an agricultural situation in Africa?
That's a very good question. And probably for the benefit of the audience, it might be worth emphasizing the difference between impact investing and socially responsible investing. So for impact investing, one of the defined objectives of the investment should be to go beyond making simply a financial return. So there must be some kind of social, environmental, or other positive impact that the fund is seeking to achieve. And the fund must clearly define that objective and must be able to quantify and measure that objective. In the case of our fund, it was improving the incomes and improving the livelihoods of smallholder farmers. That meant for every investment we looked at, we had to identify how it credibly or demonstrably impacted the lives of smallholder farmers. And whereas with socially responsible investment, it can be anything from avoiding investing in casinos or extractive industries or in industries that pollute the environment. And for most people, just by avoiding bad sectors, they tick the box for socially responsible investments. And one of the challenges we're seeing in the market right now is that people try to conflate the two. Some call it greenwashing or impact washing, where people pick the easiest of the impact objectives and say, yep, we're an impact investment fund, and yet we can generate great financial returns. But the fact is, depending on the type of problem you're trying to solve, there might be a financial cost of doing so. So back to how we blend, get the NGOs and the commercial investors together. The onus then lies on folks like Mezu and myself to very clearly define the blend of impacts the blend between impact and financial return that we're aiming to deliver with our vehicles, and then bring together the right blend of NGOs or donor funding and commercial funding, and structure funds where all of these investors achieve the objectives that they're looking for. So for instance, you find that NGOs may say they want to improve the livelihoods of a certain number of people. Historically, the only mechanism they had was to give grants to lots of small organizations scattered around the countryside. Right. What we found, and probably this may be airing the sector's dirty linen in public, is many of these institutions became addicted to free money. And they'll just take free money year in, year out, present the same plot of land to 10 different donors and take 10 different grants for doing very little work without there being any impact. But when you bring it into the mix, an impact investor whose whole ethos is around linking every dollar to a certain outcome, then you can bring that donor money to much better use, where you can actually track real outcomes that are achieved. And I think from where I'm sitting, that's what I find is of most interest to our donors, that we bring a certain investment discipline to delivering the impact outcomes that they're looking for. So you can do this, bring in the commercial capital within a certain ratio, where even your gross returns are a bit lower than you'd normally get across all the capital, across the blended capital, you can still get commercially viable returns on the portion of the capital that is commercial. So this is an evolving space, and there's a lot of work that needs to be done by the deployers of capital like ourselves, and a lot of engagement that we need to do with potential investors so we can bring them together in the right way within the right structures.
Thank you. Thank you. Yeah. One more question, because we're running late, and this is really going to be a question for all of you, but let's start with you, Jerry. And that's a little insider trading here. What would you recommend? What do you feel are the biggest opportunities for investors, for lenders, for grant makers, for the communities that's looking to support, improve livelihoods, incomes, agriculture, agribusiness, which typically would draft be 4 times as large as the primary agricultural sector in most countries. What are the big opportunities, even policymakers? Where would you point them in your view? And I'd like to share that question with Mezu and Deje as well. What would you say? Because I have money I got to invest. I got money to burn, and I'm looking for my investment. Where should I put it?
Oh, that's a slightly different question from the one I heard before about where the opportunity lies. But I'll probably,
stick with that.
Given that I've had with the experience I've had working with NGOs and commercial investors, I think I've become convinced that collaboration and effective collaboration across different sectors, and now I'm going to add to that group the public sector or the governments, is really key. So if I had to pick one type of intervention, one type of opportunity that needs to be mined a lot more than it has been in the past, it is the idea of trying to invest across a value chain, but in collaboration with all these parties. With the government, who will provide the policy support, infrastructure, etc. With the NGOs, who can bring to the table concessionary capital, and then with disciplined investors like ourselves who try to tie everything together and ensure that all the elements of the value chain work together effectively. So, Could the government of Ghana come together with NGOs and private sector players like ourselves and say, look, we're going to make our poultry value chain the biggest engine for job creation in Ghana over the next 10 years, and come up with a concerted plan alongside all of these parties and say, look, if you're an NGO and you're in Ghana, we want your dollars to go into this project, and it is going to be coordinated centrally, and we're going to make it really an engine for job creation and wealth creation for hundreds of thousands of people, while at the same time developing an end-to-end integrated poultry sector, right? From soy cultivation, maize cultivation, all the way through to local versions of KFC or other packaged poultry products. I think if we had to focus on one big idea, that's the kind of idea that I think could really help.
Well, I couldn't agree with you more on that. We've seen other countries, a couple particularly in Asia, who have done that, who have achieved true alignment within the stakeholder community to achieve, unprecedented results. I mean, Vietnam, I think, has had a growth rate in the double digits for 30 years annually. And, when Japan lost the war, they had absolutely nothing. And look what they've turned into. And South Korea is another great example of government intervention in a positive way. Private sector, government, academia, international community. Thank you very much for that. Mizzou, do you have a quick comment on that?
Sure, and I agree entirely with everything Jerry mentioned. And so another lens to that is, you have a small company that you want to build to a $100 million company or a $500 million company. Mm-hmm. And there are different interventions that need to be done across that spectrum through the company's growth phase. And not just in the company itself, but the ecosystem, the suppliers, route to market. So how are you organizing those interventions, across that growth cycle? How are you enabling the ecosystem support with the entrepreneurs as they are starting off in terms of, whether it's business parks, whether it's technical support, whether it's initial funding to get them started. Then as they're scaling, how you're providing a different type of capital, a different type of technical support. And then I think just really thinking through that growth phase and figuring out, who should intervene, when should they intervene, and what intervention is required, so that you can ensure that the companies continue to scale and you have that pipeline of companies, going through that cycle. And I think that's very critical. And, there's stuff that can be done around policy, there's stuff that can be done around technical support, and of course, different capital providers. So different capital for the earlier stage companies and different capital for growth and for more mature.
It's indeed a complex landscape. I agree. Thank you. Thank you. Deji.
Yeah, I think the classical MBA answer is it depends. But generally, if it's from a bilateral, multilateral public funding, I would agree with Ms. earlier on irrigation. Irrigation is indeed a critical infrastructure that is needed. Only about 3 or 4% of food out of Africa is grown from irrigated land. So that needs to scale up aggressively to manage the volatility and spikes in prices. From a commercial capital, I would bet on processing. So primary food processing or sort of B2B raw material processing companies that then onward sell into larger processing companies is where I'll put my bet on.
All right, thank you. And back to Jerry. Jerry, thank you for your passion about job-based economic growth and your experience as an advisor to the likes of Accenture and Merrill Lynch and UBS seems to have played a key role in your success. Clearly, communication, cooperation, and collaboration needs to improve in Africa, even within the government, even between state and federal government, with the various NGOs and business associations. So that concludes, we've got 5 minutes, that concludes our presentations. And with the remaining time left, I'd like to open the floor to questions. Some have come in, and the first one that is a great question. It's a sensational question from Stan Amadji. And his question was about exits. And what does the panel think about exits in the food and agricultural sector in Africa? Timing, size, the way you play that, assuming that you're in for a certain amount of years and you're not this isn't a cash flow investment. This is an equity investment where you're looking to exit at a decent return. How difficult is it? Are you looking at trade partners? Are you looking at another fund? Are you looking at LBOs and MBOs? What's the exit picture? Let's start with Mizzou, please.
Yep, yeah, I'll go first. And we're actually in the middle of an exit process now. But I think the context, because there's some assumptions behind that question that imply that it's harder in this sector. And I want to take a step back and say that these are companies that have built some size, some track record, and they could be packaging food. Packaged food. They could be a broad range of different sectors. And ultimately, the bigger determinant on ease of exit is probably tied to the size of the company versus the sector. So the larger the entity is, the easier it is to exit from. The smaller, the harder. But from an approach perspective, I think all of us here use the same tools. So going into the deal, we're very attentive to the range of different options. If we think that it may be harder to find a strategic or financial buyer, then we look at self-liquidating instruments. I know for the current exit process that we're going through now, we're having conversations with strategics, but at the same time, we have both a put back to the founders as well as a liquidating feature to get the return profile that we want. So there are a range of different options out there, both strategic, financial, liquidating instruments. But ultimately, I think it's just to take a step back and say that, at least from my perspective, I don't think there is a difference in ability to exit just by nature of the sector. I think it really comes down to the size and the financial performance of the entity more than sector specific.
Yeah, I would tend to. Adam, were you going to say something?
Yeah, I was just going to say, no one would argue that the food market is shrinking. And when you look at the population growth and the fact that Nigeria will be the third largest country in the world after China and India in 2050, there's plenty of runway to grow and expand. But yeah, let's go to Jerry, another experienced exiter in this space. What would your perspective be?
Well, I would tend to agree with everything Mizzou has said. As I think for PE in Africa in general, managers need to deploy the full range of potential exit options. Yeah. And he's right. The biggest driver is the size and the success of the business. We've seen an exit where we implemented. It was a blend of self-liquidating instruments and a put to the promoter. That's one. We're currently in about discussions with about 2 of our companies with strategics. I think both cases local strategics, but one of them backed by an international investor. And in some cases, we've also sold some strategic assets of some companies to local strategics as well. So it really comes down to having a good quality asset. And once you have a good quality asset, there'll be lots of takers to come and pick it up and grow it to the next stage for you. Yeah. One thing I'd like to say though is, tied into the size argument is the whole issue of how much time it takes to get to the scale that you want, and the extent to which our current fund lifespans permit us the time to do this. But that's probably a discussion for another day.
Yes, but that's a very interesting question indeed. Indeed. Deji, as you don't necessarily exit in your business model, I'd like to go to you with another question, which is about women. And women in agriculture, women borrowing. There's situations in Nigeria where banks will loan at a lower interest rate to women because the payback rates are empirically better. So from a gender equity point of view, what in getting credit and getting the assistance either an SME business or a smallholder farmer needs, what is your perspective on the gender aspect of that and what's being done and what needs to be done?
Yeah, I think statistics show us that definitely they are a more credit-worthy group. If we look at data, we look at repayment data. And if we also look at things around ability to coordinate, the female gender just comes naturally to them, while you struggle to work. And when you have farmers that have the size of a football field and tens of thousands of them, capacity to coordinate becomes very important. So they definitely fit into that model perfectly. And we've seen some exciting numbers in terms of, a group that has grown in 4 years their working capital has grown by almost 30-fold in just 4 years as a group. Now, when we look at it, there are certain stereotypes that limit these things. So they're religious, there are geographic issues, particularly in northern Nigeria, or areas that then sort of limit the level of access. Now, where we've seen some of the countries that have been able to manage this, in Rwanda, for instance, is the issue of identity. When you have financial identity for every citizen, it starts to reduce the stereotypes, and it starts to remove the gender, the religious or the cultural biases that then influence the level of access that people can get. We don't have that in Nigeria. Currently, we have 27% of our women, 37% of our portfolio farmers as female farmers, and our aspiration is to grow that to 35 years in a couple years. But to also put it in context is that we work predominantly in northern Nigeria, where there are a lot of these issues.
Thank you. Thank you. Well, we've run out of time. I really thank, before closing, I'd like to expressly thank our speakers who donated their time for this webinar. I really appreciate the work you've done in preparing for this and making it happen. Thanks, guys. I'd also like to thank the Global Policy Institute and Bay Atlantic University for hosting this event, and especially GPI's president and thought leader, Paulo von Schirach, who was speaking to us earlier, as well as GPI's executive director, Denise Caritas, who was, she's the one behind the scenes putting all of this together. And without her, this would never have happened. And lastly, I want to thank you, the audience, the participants, for your interest and commitment to what I think is one of the most serious challenges we face today and one of the greatest opportunities on the planet. So I hope to see you next week, Tuesday, May 4th, for the second webinar on sustainable agriculture. That will be entitled Connecting Farmers to Markets. It will carry on some of the themes from today, but we'll also look at some innovative models in making sure that in reducing waste and making sure that farmers are getting the income that they deserve and not being treated as second-class citizens or the first person in the value chain who normally is taken advantage of. So thank you to everybody. Have a good week. I will hand it back over to GPI if they are here. Is that Denise or
yes.
Samin? Are you here? Okay,
Denise,
great.
yes.
Again,
thank
great.
you so much, Mr. Safar. Looking forward to seeing you next week.
Okay, thanks
Thank you
everyone.
to all panelists.
Thank you, everyone. Have a good day.
Thank you. Thanks for the opportunity.